Imagine a tiny snowball rolling down a mountain. At first, it's small, almost insignificant. But with every turn, it picks up more snow, growing larger and faster until it becomes an unstoppable force. This, in essence, is the power of compounding, and it's about to become your greatest financial ally. If you want to unlock the secrets to making your money work harder for you, hit that subscribe button now. In your 20s and 30s, time is your most valuable asset. Compound interest, often called the eighth wonder of the world, is the magic that allows your money to grow exponentially. It's not just about saving, it's about making your savings earn more savings. This isn't some complex Wall Street secret. It's a fundamental principle that, when understood and applied early, can transform your financial future. We're going to demystify how this works, showing you how to harness its power to build substantial wealth, not by working harder, but by letting your money do the heavy lifting for you year after year. Welcome to the crucial first step in building your financial future, defining your financial North Star. What does financial success truly look like for you? It's more than just a number. It's about the life you want to live, the security you want to feel, and the dreams you want to achieve. Let's break down how to set clear, achievable goals. Think about your short-term aspirations, perhaps saving for a down payment on a car or building a robust emergency fund. These are your immediate milestones, the steps that build momentum. Then, consider your long-term vision. This might be financial independence, early retirement, or the ability to travel the world. These larger goals provide direction and motivation. By clearly defining both your short-term and long-term financial goals, you create a roadmap. This roadmap will guide every decision you make, from budgeting and saving to investing in debt management. It's the foundation upon which all effective financial planning is built. Let's make sure your financial journey has a clear destination. Understanding where your money goes is the first step to taking control of your finances. And one of the most popular and effective tools for this is the 50/30/20 rule. This simple framework helps you allocate your income into three key categories. First, we have needs, which should account for about 50% of your after-tax income. These are your essential expenses: rent or mortgage, utilities, groceries, transportation, and minimum debt payments. They're the non-negotiables. Next, the wants category takes up roughly 30%. This is where you allocate money for things that improve your quality of life, but aren't strictly necessary. Think dining out, entertainment, hobbies, travel, and subscriptions. It's about enjoying your hard-earned money responsibly. Finally, and critically, is savings and debt repayment. This crucial 20% is dedicated to building your financial future. It includes saving for your emergency fund, investing for retirement, and making extra payments towards debt, especially high-interest debt. By consistently prioritizing this 20%, you're actively working towards financial security and wealth building. The 50/30/20 rule provides a clear, actionable roadmap to balance your current lifestyle with your future goals. Understanding where your money goes is the absolutely crucial first step to taking control of your finances. This is where tracking your spending comes in. It might sound tedious, but think of it as gaining a superpower: the power of insight into your own financial habits. There are many effective tools to help you. Simple spreadsheets can be a great starting point, allowing you to categorize every expense. For those who prefer a more automated approach, numerous budgeting apps are available. These often link directly to your bank accounts and credit cards, automatically categorizing transactions for you. Some even offer visual reports, making it easy to see your spending patterns at a glance. Beyond the tools, it's about building sustainable habits. Set aside a few minutes each week, perhaps while you enjoy your morning coffee, to review your spending. Don't aim for perfection right away. The goal is progress. By consistently observing where your money is going, you'll start to identify areas where you can make adjustments, freeing up more funds for your savings and investment goals. This awareness is the foundation of smart financial management. Life happens. And sometimes, life happens unexpectedly. That's precisely why an emergency fund isn't just a good idea, it's absolutely non-negotiable. Think of it as your personal financial safety net, a buffer against the unpredictable. Job loss, a sudden medical expense, a car repair that can't wait. These aren't hypothetical scenarios. They're realities many face. Without an emergency fund, these curveballs can quickly send you spiraling into debt, adding financial stress to an already difficult situation. This fund is your shield. It allows you to navigate these challenges without derailing your long-term financial goals. It provides peace of mind, knowing you have a cushion to fall back on. Building this fund might seem daunting, but it's one of the most empowering first steps you can take in securing your financial future. It's the foundation upon which all other wealth-building strategies are built. Understanding how much to save for an emergency fund and where to keep it is a vital step in building financial security. The general recommendation is to have 3 to 6 months worth of essential living expenses saved. To figure out your personal target, look at your monthly budget. Tally up your non-negotiable costs like rent or mortgage, utilities, groceries, transportation, and minimum debt payments. Multiply that total by 3, then by 6. This range gives you your ideal emergency fund size. Now, where should you keep this crucial safety net? The key is accessibility and safety. You want to be able to get to this money quickly if an unexpected event occurs, but you also don't want it so easily accessible that you're tempted to dip into it for non-emergencies. A high-yield savings account is often the perfect solution. These accounts offer a better interest rate than traditional savings accounts, helping your money grow slightly, while still ensuring it's readily available and FDIC insured for protection. Avoid investing your emergency fund in the stock market, as its value can fluctuate, and you don't want to risk losing money when you might need it most. When it comes to building wealth early, one of the most crucial steps you can take in your 20s and 30s is to aggressively tackle high-interest debt. Think credit cards, payday loans, or any debt with an interest rate that climbs quickly. This type of debt is a silent wealth killer, silently eating away at your money and hindering your progress. The interest you pay on these debts isn't just a small fee, it's a significant cost that compounds over time. By prioritizing and paying down this debt first, you're essentially giving yourself a guaranteed, risk-free return on your money. Every dollar you pay towards high-interest debt is a dollar you won't have to pay in interest later. This strategy frees up more of your income, allowing you to save and invest sooner, accelerating your journey towards financial independence. Let's explore how to make this happen effectively. Navigating student loans and planning for a mortgage can feel like a balancing act, but with the right strategies, it's entirely manageable. Understanding your student loan repayment options is the first crucial step. Explore income-driven repayment plans that adjust your monthly payments based on your earnings. Consider refinancing if you have a good credit score and a stable income, potentially lowering your interest rate and saving you money over the life of the loan. When it comes to mortgages, the key is realistic budgeting. Factor in not just the principal and interest, but also property taxes, homeowners insurance, and potential maintenance costs. Aim to save a substantial down payment, as this can reduce your monthly payments and private mortgage insurance. By proactively managing your student debt and creating a solid mortgage plan, you're building a stronger financial future, one step at a time. Investing might sound complex, but it doesn't have to be, especially when you're just starting out. That's where index funds come in. Think of an index fund as a pre-made basket of stocks. Instead of picking individual companies, you're buying a tiny piece of many different ones all at once. These funds aim to mirror the performance of a specific market index, like the S&P 500, which represents 500 of the largest U.S. companies. Why are they so popular, especially for beginners? Simplicity, diversification, and crucially, low costs. Because index funds aren't actively managed by a team trying to beat the market, their fees are significantly lower than traditional mutual funds. This means more of your money stays invested, working for you. For long-term wealth building, index funds offer a powerful and straightforward approach. They provide broad market exposure, reducing the risk associated with individual stock picks, and let you participate in the overall growth of the economy. They're an excellent foundation for anyone looking to build wealth early. When it comes to building wealth early, one of the most straightforward and powerful strategies available to you is taking full advantage of your employer's 401k matching program. Think of it as free money. Many employers offer to match a portion of your contributions to your 401k plan. This means for every dollar you put in, your employer puts in some of their own. It's an immediate, guaranteed return on your investment, and it significantly accelerates your retirement savings. Not contributing enough to get the full match is essentially leaving money on the table, money that could be growing for your future. Prioritizing contributions to capture that full employer match should be a top financial goal. It's one of the easiest ways to boost your savings without even feeling the pinch as much. Make sure you understand your company's specific matching formula and aim to contribute at least enough to get every last cent of that match. This simple step can make a massive difference in your long-term financial security. Welcome back. Now that we've laid the groundwork for smart saving and investing, let's talk about a retirement powerhouse specifically designed for tax-free growth, the Roth IRA. Think of a Roth IRA as a special savings account for your retirement. The magic here is in the tax-free part. You contribute money that you've already paid taxes on. Then, your investments grow completely tax-free. The real benefit comes later. When you retire, qualified withdrawals from your Roth IRA are also tax-free. This means more money in your pocket when you need it most. To be eligible, there are income limitations, which we'll touch on later. For now, understand that contributions are made with after-tax dollars, and there are annual limits on how much you can contribute. The Roth IRA is an excellent tool for young investors, as the longer your money has to grow, the more significant the tax-free benefit becomes. It's a fantastic way to build a substantial nest egg with future tax certainty. As you build wealth in your 20s and 30s, understanding diversification and your personal risk tolerance is crucial. Diversification means spreading your investments across different types of assets, like stocks, bonds, and even real estate. Think of it as not putting all your eggs in one basket. This strategy helps to manage risk, because if one investment performs poorly, others may perform well, smoothing out your overall returns. Now let's talk about risk tolerance. This is your personal comfort level with potential investment losses in exchange for potentially higher gains. It's not static. It can change over time. Early in your career, you might have a higher tolerance for risk because you have a longer time horizon to recover from any downturns. As you get older, or as your financial situation changes, your risk tolerance might decrease. It's important to regularly assess how you feel about risk and align your investment choices accordingly. This ensures your portfolio remains comfortable and aligned with your long-term financial goals. As your income grows, it's tempting to let your spending grow right along with it. This common pitfall is known as lifestyle inflation. It's a silent wealth killer, where every raise or bonus gets absorbed into a slightly upgraded car, a fancier apartment, or more frequent dining out. Before you know it, you're earning more than ever, but you're no closer to your long-term financial goals. The key is to recognize this trap and actively resist it. When you receive a pay increase, make a conscious decision to direct a significant portion of that extra money towards your savings and investments, rather than your immediate desires. Think of it as paying your future self first. Strategies to maintain financial discipline include automating your savings. Set up automatic transfers to your investment accounts each payday so the money is saved before you even have a chance to spend it. Regularly review your budget and identify areas where you can still cut back, even with a higher income. And most importantly, keep your long-term financial vision front and center. Remind yourself why you're saving and investing in the first place, and use that motivation to stay on track. Your credit score. It's more than just a number. It's a key that unlocks significant financial opportunities. In your 20s and 30s, establishing and maintaining a strong credit score is a powerful tool for building wealth early. Think of it as your financial reputation. Lenders, landlords, and even some employers look at it to gauge your reliability. A higher score means better interest rates on loans, whether it's for a car, a home, or even credit cards. This translates directly into saving money over time. So, how do you build and maintain a good one? Consistency is key. The most impactful factor is paying your bills on time. Every time. Payment history makes up a large portion of your score. Another important element is credit utilization. That's the amount of credit you're using compared to your total available credit. Keeping this ratio low, ideally below 30%, signals responsible borrowing. Opening a credit card and using it for small, everyday purchases, then paying it off in full each month can be an excellent way to build a positive history. Avoid opening too many accounts at once, as this can temporarily lower your score. Remember, a strong credit score isn't just about borrowing. It's about building trust and demonstrating financial maturity. It's a foundational piece of your financial plan, paving the way for future success.